Hello, this is George Sandman. I'm the founder and CEO of Growth Drive. And Growth Drive is a system used by business advisors to drive client profits, growth, and value. Now, we're also a community. Every week we get together to talk about all things business advisor, everything clients, cases, things we're seeing out in the world. Now, tune in here to this podcast, and you can join the conversation by scanning this QR code, passcode 867-5309. Jump into the conversation. Everyone's welcome. We're looking forward to having you. So here we go. On with the show.
Hey guys, how are you?
Hey, Mike, how are you doing?
Well, can't complain. I could.
I was going to ask you, are you the gent that put the presentation on deal structure with taxes? Is that you? Okay. So I'd love to get to know you a little better. And I came from that world too. I'm actually a transaction lawyer. I do
Great.
all those deals many years ago and do a lot of internal transfer work today. And I'm not a tax expert. I'm not a CPA, but I would love to.
Yeah, sure.
Let's see if we can make
Don
this
Carter,
connection.
I got your name. Yeah, I have another one of these things coming on tomorrow afternoon.
Okay. Yeah.
Another electrifying webinar on tax. But
No, it's a great topic.
tomorrow's going to be a little bit more, about terms, when you have purchase price application issues and stuff like that. Anyway, I don't want to put everyone to sleep, but that's what the topics are tomorrow. Purchase price allocation and all the different things that go into the final agreement, right? So I'll talk about those tomorrow. But yeah, sure. And then you're talking about internal transfers, right?
Well, both, but you primarily,
Yeah. So I am reaching over here. So I wrote this little book called The Inside Game, and it talks about how to successfully stage an internal transfer, particularly navigating the tax landscape, because you could do it right and you could do it wrong. And if you do it wrong, give Uncle Sam a big chunk of all the cash flow needed to execute these things.
Yep.
So,
all right. Well, I'll check up with you offline, Mike.
Sure.
We'll connect later.
Will do. Thank you. Hey, Eric, how are you, sir?
Doing well. How are you guys?
I can't complain.
See you guys.
Wow, we have a combination of some of the usual suspects and some newer people that mixing up the group here a little.
Except John can't talk. He's chewing on something that must be very tasty.
Yeah, I was finishing my bagel as I jumped on.
I had my protein drink and my pills. So
yeah, at 3 a.m. in the morning or whatever it is in Portland right now, right?
No, 6:30.
6:30.
Not that bad. Got my morning meditations done, so we're good to go for the rest of the day.
Nice. So, are your trucking companies going to recover now that we're going to have oil again?
Yeah, but slowly. The latest forecast I saw showed not much change from last year. We should be doing like 350,000 trucks a year, new production.
Yep.
But we've been down in the 250 range for the last couple of years. This year's slightly better. Next year is not forecast to be much better. But then 2028 is when we get back to 320,000 or so.
Are you including manufacturer of non-driver trucks as well? Is that in that number, or is this traditional?
The 1,000 trucks that might represent? Yeah, it includes those.
Is that really that small?
Yeah, it is.
Okay. What are they?
That's not annual production. That's what's on the road.
On the road, yeah. Oh, okay, got it. When are they? If you listen to the news, you'd think that a quarter of the trucks are going to be that in a year or something. What is the projection for non-driver trucks over the next 5 years?
Let's see. We're trying to think of the latest forecast I would have seen that would address that. Under 3% by 2030, even 2035, you're still going to be under 5%.
So not even close to material in the.
No.
Yeah.
No. But it's exciting. It's Congress is working on creating frameworks. I have presentations that I have people make on it. We respond to things because it's all about cameras and radar and lidar and those types of things. And there are, Pepsi has Teslas in production. There's a new company that is starting to sell. There were 600 units ordered for the ports, which is already a strange looking truck. You may be familiar with the yard jockey.
Yep.
For those of you who haven't seen it, it's a truck with only a seat for the driver, and there's no cab on the other half of the truck.
Yeah.
And it's just used to haul containers around in the ports.
In the yard. Yeah. Right.
So that's a good place for.
Put a stop to that.
Pardon?
Surprised the unions didn't put a stop to that.
Well, they're driving them.
That's a good point. Yeah,
Oh no, but there's got to be another seat for the person who's got to be there in case the driver needs to go on break.
Yeah, that's called a deadhead, isn't it, Tip? There's a name for that.
Got it, baby.
It's a deadhead.
That's a new definition of deadheading. I like.
It's a union. He's right. It's a hired position. It's unionized. It's insured. And there's requirements around what that person can do, when they can do it. It's fascinating.
Yeah.
But in the last Teamsters contract or longshoreman's contract, they allowed a certain number of autonomous vehicles to be included in that. Of course, there had to be a huge pay increase and variety.
There were
of
concessions made for it. Yeah.
Yeah. I mean, a longshoreman now is up in the $50 or $60 an hour range, I think, for what they're getting paid. It's a little bit more than a UAW employee.
Wow.
But it's fun stuff. But
yeah, it's fascinating. We also, if I'm not mistaken, Paul, we have the least advanced equipment for offloading stuff from ships in the first, not third world countries, but first world countries. Like China has better, Japan has better. There's a lot more automation in other countries.
And I would ascribe a good deal of that to the longshoremen.
Yeah, no doubt. Yeah.
Well, what's on people's minds in terms of our business clients or our, operating our businesses, as just so we stay on topic for Coffee Klatsch? I mean, interesting side stuff, but what are people seeing, or what's hot this week?
Well, I confirmed Dimension 1 for my company yesterday when I closed the books for May. So that's good.
Mm-hmm.
It was predictable, huh?
It was. For you CPA people, it was hard to document everything with a physical receipt. So, for instance, Uber rides, you don't get a receipt, and where the hell is a receipt for that? Do you need to even print out that receipt, or you can say, well, you log into my Uber account, and then you can see the receipts, including the tips. Strange to me.
Well, here's the thing that I know is pretty much a tax reality today, right? Do you know what the audit rate is?
Very small. And I've never been audited.
Yeah. Well, there you go. It's like 1%. So, yeah, I mean, everyone talks about all this documentation, and yes, you should have it, and no doubt you should document everything. But, people get to the point like you, Paul, where they say, well, I've never been audited. So, I mean, how meticulous do I need to be? And that's kind of the reality. I mean, so people play very fast and loose with all the rules, documentation in particular. They just, I've seen it 1,000 times.
Which is fine when it's like me and it's not a big growth industry and I'm not looking to exit. But when you try to look to exit or raise some money and try to justify it to the bank or private bank or whomever, now it may make a big difference.
Or just go through due diligence, Paul, right?
Yeah.
Right, because now you're not getting an IRS audit, but somebody's going to come look at stuff and say, hey, where is some of this stuff, right?
Yeah, I'd hate to have them look at what I declare as dues and subscriptions and get into the details of that.
Those are just normal add backs, right?
Yeah.
Right. They would be.
Yep.
Hey guys, I have a question since you're talking about audits. I was with a client yesterday. They're not interested in ever selling since they're in the process of moving to the next generation. It's the case study for those in the case study group.
Okay.
So they hire an accounting firm to do a full due diligence audit valuation every 5 years. So they have a good understanding.
What do you mean
Larry,
by
just
that?
let's come back and
Well, no,
clarify.
they do evaluation. They don't
Evaluation. Okay,
They don't
not
do
an
due
audit.
diligence.
Yeah.
They're not selling. They're not doing due diligence. They're
Okay,
doing
just the value.
evaluation every 5 years.
Okay.
Is that smart? Should they do it
Family owned?
family owned?
Yeah. I mean, at some point you need to be able to talk about an independent look at what the value of the company is on a regular basis, right? If you don't do that, you're relying on somebody doing a quick calculation or some sort of formula driven answer for how much the shares are worth. So that every year, every 5 year valuation gives you the independent look at, is this really, it's an appraisal on your house, right?
Right.
It gives you that independent look rather than just a broker saying, yeah, I could probably sell that for 700,000, right? Right. So
What are they using it for, Larry? Why do they do it? What's the purpose of
The
it?
owner just thinks it's smart to have it.
Just smart to have.
Just it's
but there
smart
are
to have
multiple
outside,
owners.
and they pay up to over 30,000 the last time they did it.
Yeah,
And
that's
do they
about
have
right.
multiple?
Mm-hmm.
Do they have multiple owners?
No, just technically the owner's
Yeah.
mother still has shares, but she's
I see two reasons to be doing it for you, Larry. One is transition within the family at
Yep.
some point in time for tax purposes.
we talked about that yesterday. Yeah.
The other is unless they're going to grow entirely organically off their own cash flow, if they need any money from outside, they might have to justify
Mhm.
things.
The reason to be doing it might be estate planning as well, but
Yeah.
right. But that's not the business transfer stuff. That's their own personal stuff, right?
And we talked about all three yesterday in terms of their next audit. I say audit,
Evaluation.
Yeah.
Yeah, so that's a good topic, Larry, because I like sometimes I get into a discussion of how to bridge that type of valuation, which is, I guess, a formal valuation, which costs, like you say, 20, 30 grand. And they do, I know how they do it. They do a multiple approaches, and then they weight different approaches and they come up with a value. How does that, let's talk about how does that compare to, the valuation we kind of come up with, or Growth Drive comes up with when you
It was
do
half. Growth Drive was half.
Yeah.
His estimated, based on his last valuation a few years ago,
right.
and their growth in the last few years, inorganic and organic, he estimates our Growth Drive was probably about half, a little more than half.
It showed a value that was half of the
The valuation,
the certified valuation.
certified
So,
value. Here's the reason why he said
that. How did you reconcile?
wholesale trade is too broad. When you break down wholesale trade into its more specific industry, your multiple is going to be different. Our multiple in Growth Drive for wholesale trade is 2.5 to 6. His, when you really break it down, is 8 to 12.
So, but you can override the Growth Drive defaults and
I'm
put
going to
your
do that.
multiples in there.
Yeah, we just met. This was the case study, and yesterday was the day we met and spent half a day diving deep. And so I'm updating based on Clarity 2. I'm updating the case, what we've done in Growth Drive to refresh it.
So just Mike, great question that you asked. What's the difference? And I know you were going after Larry's thing, but just for everybody's benefit, what we're talking about that Larry's company is having is called a certified valuation, right? That certified valuation, as you rightly said, Mike, includes usually multiple ways to look at it, right? It might have a discounted cash flow. It might have a comparables. It also might have a market value, right? And then they weight all those and then they come up. And by the way, important distinction, typically done by a CVA and under ethical constraints, just like a CPA is, to do that work in a certain way to certain standards. What we're doing would be classified, what Clarity is doing would be classified as a calculation of value, and that calculation of value is never meant to replace the full valuation. And Mike, I know you know this stuff. I'm really just
Agree with you. I
right,
agree with you.
right. And so we have to remember, and Larry, your point is a really great one. We're doing a broad brush calculation of value. First of all, on the multiple side, we have to be careful because the data that's coming down gives us broad categories, and they may be a niche player like you described, Larry. The other side of the coin is, I don't know that most people who are using Clarity are probably doing the adjustments that they should do to the EBITDA side. Are they entering net income right off the P&L? Are they just calculating EBITDA and putting it in? Are they doing adjustments to that? And by the way, if you do a valuation at the certified level, you don't just use last year's EBITDA adjusted, you use a weighted average of the last 3 to 5 years of adjusted EBITDA. And so the thing that we're doing in Clarity is not nearly as complex or as rigorous as obviously, we all knew that, but these are the kinds of things we need to think about when we're doing it, right? And just be aware of those things, because it's important to know what we're serving up with the Clarity valuation, right? And I say this for those on the call, I say it for anybody who's watching this, just be aware of what you're serving. There's nothing wrong with it, but when we do it, we need to be aware that it isn't what we would get through a full certified valuation for a number of reasons. Good point.
The other thing too, Eric, just to add what you're saying too, the Clarity valuation process, or the process itself, takes into account strategic capacity,
which is excellent.
Yeah, which a certified valuation does not.
Correct. So it has some advantages over the certified valuation, right? If we do when we do it, we actually do a spreadsheet. We do 3 years. We weight the 3 years. We adjust for EBITDA to adjusted EBITDA on the things that should be adjusted. That's the number we enter. And then we often look at the multiples and decide whether the multiple range is representative of that company. So we're doing a little more rigorous than you would get out of the box of Clarity. And so I'm just reminding our audience broadly, when you think about that, guys, think about what you're serving up. Are you serving up out of the box Clarity? Nothing wrong with it. Just understand what you're doing. Are you serving up something in between? You're certainly never serving up a certified valuation, which is that's like saying, because I'm a CPA and I looked at some financial statements, it's audited. That'd be, that's a bunch of BS, right? They're not audited unless we go through the whole process of doing the audit.
The other thing, the other thing I was mentioning too was the strategic capacity analysis and how it impacts value is something else that we plug into our analysis, where you don't see that in formal valuations.
Correct.
I mean, I know they adjust the specific risk premium, right, in the discount in the cap rate, but that's I know guys, I used to work with them all the time, and they pull a number out of the air.
Mike, go look at an appraisal for a house and see how far they missed the details that are specific to your house for the adjustments, right?
So they pull some number out of the air and they plug it in as a specific risk factor. It's almost very subjective. Whereas I think we look at that specific risk and we analyze it, and we do a deep dive, and we come up with a more reliable number.
I agree. I think the effort of us going through the calculation of strategic capacity, and again, I would make the point, when we're doing our strategic capacity analysis, if we're just letting the person answer and taking whatever they answer, and we're not being objective about it and calling them on things that are probably not true, our sales process is a 4. Really, you don't have any documentation, you don't have any process, you don't use a CRM, you're a 4? Like, come on, right? Like, you know, and
It's garbage in, it's garbage in, garbage out.
right, exactly. And so we need to be aware of how well we're using the process, right? But when we do it well, I couldn't agree with you more, Mike. We're getting a much better, much more precise idea of where they fit in the range than somebody who's just grabbing two or three. Do you have a concentration of customers? Do you have this? Do you have this? And they're eyeballing it, if you will, and it's just not as accurate. So I think there's a huge advantage to having the strategic capacity in there. And if we put a little rigor into the other side of it, the math on the EBITDA, getting to a weighted adjusted EBITDA and looking at the multiples, we can get a pretty good idea of what the valuation is, and it's going to approximate where
I
it's
agree.
going to be in the. We may not be in the same seat, but we're going to be in the same section of the stadium.
With
Right.
what I've seen in AI capabilities right now of taking and interpreting a QuickBooks set of numbers and stuff, you just gave George Clarity 3.
Yeah. 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 I mean, again, I love the Clarity tool. I want to be clear. I think it's a great tool. We just got to understand what level we're giving if we're just plugging simple numbers into it, right?
Yeah.
Just
Yeah.
as if we're accepting whatever the customer says and we're not putting any rigor to that, we're going to get the wrong answer or not as good an answer, let's say, than if we actually put the rigor into looking at those components. And I realize, Mike and John, I think you have an accounting background also, don't you?
No, I have a legal background, actually. I
There you
was
go.
in
Yeah, I
the
knew it was a
yeah,
technical background,
I
but
was in the transactional world, so I know about valuation
yeah, right.
concepts, but it's
Yeah.
not my wheelhouse per
But
se.
I'm talking I'm talking because I have a strong CPA background, but there are plenty of us in the community, and I would just encourage people who aren't comfortable, give Mike or me or Anna or somebody else who's got that background a call, and we'll help you understand how to look at that, right?
So, Derek, what do you do with the DCF module in Clarity 2? Do
I
you
haven't.
utilize-
I gotta admit, I have not used it yet. I like DCF as a concept. I always have a problem with DCF because to the point you made earlier, I don't think people are really good at getting the right discount rate. I've actually looked at valuations where they'll go out and get multiples. And here's Eric geeking out for a second on technical, but if you take the reciprocal of the multiple, you should get the discount rate. And people don't understand that. So you take the reciprocal 1 over the number, right? And of multiple, and you get a totally different number than they're using as their discount rate in their DCF. And I'm like, what the hell, right? Like, this doesn't make any sense. Why, the market is saying this is the multiple rate in this area, and you're saying you're smarter than the market and you've got a discount rate that's over here, and it just doesn't make any sense to me, right? And the problem is exactly what you described, Mike. They're going through their lookup tables and their math equation, and they're not looking at the reality of what's actually happening. And that scares the crap out of me. Then you get a number that doesn't make any sense.
Yeah.
So that's not a statement about Clarity's DCF. That's a statement about DCF as a technique in general, right?
Well, why did George put it in there, though? Why did he? It felt that
Because I think the idea was to be able to have two different ways to come at it. I do agree it's better if you can come at it with two different ways that confirm each other, right? We often try to do that in the financial world, in the business world, right? Hey, we're seeing a lot of activity in this sales area, and then we go over here and read about, oh yeah, people are really liking this, right? And that confirms our idea, right? We want that confirmation, and you just got to use the tool, right? Again, it's there's nothing wrong with the tool itself. We got to apply the tool in the right way, right?
Eric, this is why for the summit, Monday morning, it makes sense to hold a session where we review the tools.
Absolutely.
So many people are just using Clarity 1, and I don't use most of the tools. George knows that.
Yeah.
And I need better education and review. So I want to, and so George is probably thinking through right now. And I think he wants to present to the summit committee, and Coffee Klatsch, what he has updated from the first round of summit agenda and purpose. But I think this Monday morning, because I'm looking right now, and I thought I knew how to change the range of value, and I'm not. It didn't accept it, so I'm doing something wrong. But I want to update this based upon this conversation.
Yeah.
So for the client, I'm not showing the default wholesale trade 42, 2.5 to 5, but I change it to 8 to 12%. But somehow I get a failed message when doing it. But
Right.
these are the things that will take us to the next level.
Yeah, for sure.
And we're not pretending, like in my case, to do a certified valuation.
Right.
Using strategic capacity, as you two, just Eric and Michael were talking about, to use that is additive to then more accurately using range of value and multiples would enhance the conversation. In my client's case, he's a $140 million revenue business. George didn't optimize the secret sauce behind everything for businesses over 100 million per se. So it's
Yeah.
I think there's
The reason we enter the reason in the tool we enter the revenue and the EBITDA or net income, sometimes some valuations are driven off of revenue. I hope we all know that. Not very many, but some. Famously, Facebook made no money when it went IPO, but it had a huge valuation because it's off of revenue, not off of EBITDA, right?
So did SpaceX.
Right. Yeah. So did SpaceX. Right. But the point, guys, is we enter revenue often because that helps us grab the right grouping of multiple ranges. Because if we don't know this, we should be aware that multiple ranges are in tranches, right? At a low revenue, you get a certain range of multiples. At a medium revenue, you get another range. And at a high level, you get a different range. And so you need to understand again that revenue size, really, not revenue, but size, and revenue is the straw man for that. Size drives different multiple ranges. So
if you go to Eric's point, if we go to the level 1 report, the actual long report, and scroll down to where we see transferable value, it begins with, depending on the industry, whether they're using revenue or he's using EBIT.
Yep.
If I'm saying that right, versus EBITDA. George uses EBIT.
Yeah, and by the way, when they're reported, they are reported typically in 3 groupings for income related things. One is EBITDA, earnings before interest, taxes, depreciation, and amortization. EBIT, interest before interest and taxes. Forget the depreciation. And then they'll talk about seller discretionary earnings, SDE. Seller discretionary earnings is really just earnings plus adding back the owner's salary. So what can the owner take home every day, every year? They take home their salary plus whatever the extra earnings are of the business. And so they'll calculate the multiple on those 3 things. If you look them up in resources like this one, or they have them electronically, those will have all 3 of those multiples. And we happen to be using EBIT versus EBITDA.
Why is that?
I don't know. I don't know why George. I can't speak to why George picked that one.
Does he? Okay, I'm just trying to think how he accounts for capital outlays and CapEx.
It's good to know which one you're doing so that if you're going to do a more rigorous add backs and calculation, that you're forming the right one to get to the multiple you're using. It's important to know which one you're using.
And then I've seen SDE for smaller companies, right?
For sure. SDE is typically Main Street more often because you can't reliably get to EBIT or EBITDA in a consistent way.
Well, I'm looking at the one of the cases I have in Clarity, and under the level 1 discovery for range of value report, there is a box for range of multiples. It's got high range, it's got low range, and it's got margin.
That's where you are trying to adjust it, Larry, right?
Say that again, Tip. What report are you looking at?
I'm looking at the level 1 report. Or sorry, not the level 1 report. I'm looking at the level 1, the range of value report right next to the clarity level 1 button
under the
or the
report.
financial data
There
button.
you
Yeah,
Down now.
there's fields that you can insert your own.
Yeah.
Low and
Yeah.
high end.
I've been
right?
spending way too much time with this lately because I'm totally lost, and it's amazing that I'm telling you this. It's very funny, actually.
Look at Tip,
Anyway.
the expert.
Yeah, right. No, but that's the do you see it there, Larry? That's the override.
So you're saying clarity
on
level
9
1, the report tab.
Yeah, the range of value report tab. You got the graph for business value comparison. Then you got the 9 box to the right. Do you hear that, Eric? 9 box. Bing, bing. I'm an insider now. And then right underneath that, you've got the range of multiples.
Right. And that's where I enter it. And I'm doing something wrong because it didn't accept it.
I thought it was on.
Did you hit submit? There is no submit.
I don't have it on, guys, but I thought it was the third tab of the actual level 1 report where you're entering the data. You go through the tabs. The first tab is all the questions. The second tab is some general information. The third tab is where you enter the revenue and the income.
You're right.
And on that, there's a override for multiples on that third tab. I think that's where you have to override it, but I have not overridden it ever. So, but that's where you would put the input, I believe.
I was looking there as well. My eyes have not caught where I need to do that.
Just
That's called the fin data. George is busy. Yeah, he's out of pocket today.
Yeah. But Larry, your bigger point, Larry, is a good one. I think we need to know how to use the different tools. But I would make another subtle point, and that is we need to know when to use the specific tools. And that's as important as how to use them. Just like Mike and I were having the discussion or sharing the information about valuations, it's when you and how, it's how, but it's when do you use these different things and how do you make those decisions? Unfortunately, that's the judgment part that we get through experience. That's the part the broader we add by being seasoned advisors. The how you do it, anybody can learn if they sit down and read the manual, if you will, or get the teaching. The when you do it is about having judgment and knowing the appropriate time to use this tool versus that tool to get you to the answer, right? And I think that's an important distinction, and it's what changes us from just being AI. We have judgment and experience that helps us understand that, yeah, in general, you might use this tool here, but there's some specific, to your point, Larry, in this area, they're not just a warehousing place, they're a niche-y little area that has a much different multiple because it's just a hot area. HVAC is getting ridiculous multiples right now, right? You can't just throw them under normal contractor. They're getting ridiculous multiples, right?
Well, warehousing right now from a transportation perspective is also becoming light manufacturing operations that people are doing. And then you have the federal zones that allow you to avoid tariffs and stuff for a period of time. So there's a lot going on in warehousing right now to change valuations.
So I was able to make the change. Thank you, Tim.
It was the third tab, right?
It is the second tab.
Oh, second tab. Sorry.
Right. And that second tab, I was doing it incorrectly. And I figured out, thanks, Tip, for just what you prompted me to want to persist. Then you go back to the main Clarity One report and hit submit again.
Right.
And it is now more than doubled valuation.
Yeah.
Based on the 8 to 12 multiple range.
Yeah.
For that same EBITDA. And George has EBIT and EBITDA in different places.
Okay.
Okay. So it is now doubled. And it's more reflective of what the owner told me he believed his valuation is.
Nice.
Now, by doing that, then adding the strategic capacity so that in the range of values, we are representing where along the range of values, that multiple, they really are
That's
based
the key.
on strategic
Yep.
capacity. It makes a difference.
It
And
does
Yeah,
make a huge difference.
we went
but the other thing, Larry,
did a clarity 2 as well.
but the other thing, Larry, is that with Growth Drive, with that clarity report does show them, yeah, it could show them what their current value is today, but more importantly is it could show them, and you could actually pro forma or project what it could be if
Yep.
they increase their strategic capacity, which you will not get in a formal valuation.
Yeah.
You'll get,
Guys, one thing we
read
gotta
right
be careful
now,
about.
you'll get a read in time, but the clarity tool says, look, this is where you are today at your current strategic capacity. But if you go to that, there's a tab, and I forgot where it is, but you could yes, equity planner. The equity planner, you could change the strategic capacity score, or not the score itself, but you could change the
range.
the multiple ranges, right? You could change that. Is that what gets changed, Eric, or what do you change in that thing? That
No, what it does is it increases, it shows, guys, what there are two factors that can change it, right? Where you are in the range,
right,
and where your earnings are. If
right,
earnings is driving the multiple. So what it does is, I always do this anyway. I create a matrix. Earnings, and on the vertical is multiple, and in the range of multiple changing, and then you show them where they are. And the whole idea of range of value is, you don't just want to go up or just to the right. You want to go to the right because you get the benefit of both the change in the valuation for the multiple, and you earn more money. So
you can change the growth rate as well.
Yeah, correct. Tip,
No, I do want to make a point, and that's that, because I've been in this position before, and that's, Mr. Larry Prince is dealing with a situation where he's meeting with somebody and he's like a full grid off, right? I mean, he's showing a valuation that's half of what the valuation that they got that's certified, right? I mean, Larry's known these people for a while, but I mean, if we're new, that can kind of compromise our thank God Ed's here. Now the adults in the room. But that can compromise our, how we're perceived. But, I think we should be really careful about how accurate we're standing behind the math, because in the end, for the work that we do, we're looking for the gaps. The whole point in the report is the gaps in strategic capacity. We're not CPAs, and well, some of us are, most of us are not. The really cool guys are, but not most of us.
I don't think Jemiah is a CPA.
But I want to be really clear. Like, if we're creating an engagement, we're not valuation experts. We're playing to the gaps in terms of strengthening the multiple for these clients. I just
your point, and it was the
but again, I want to honor what Larry was dealing with. And that's
right. I just want to jump in. I'm sorry, Eric. Tip. The whole purpose of what I'm doing with them, and they've been a client for 2 years.
Yeah.
Peer group, both different peer groups, and also management development on many other things. This was never yesterday going to be about valuation.
Right.
All about strategic capacity. We dove deep in Clarity 2 into 3 areas and developed action plan that we're going to see through and get back and do another deep dive in November around a couple other items. The valuation discussion for today, that was secondary. They didn't even, and I framed it saying that this is not a true valuation.
No, agreed, Larry, 100%. What I'm saying is that if you did not have those 2 years and you went in and they did have a certified valuation from a couple of years ago, and you're coming up with something that's half, that is where we can get ourselves into some trouble.
Yeah. Agreed.
Yeah.
And Tip, that was the point I was making with, we're not, we got to be careful what we're representing, because we're not doing all the steps that would make it more accurate, right? And so it's really, I see it as a relative thing, not that it can't get us an idea where we are if we're careful about it, but more importantly, it helps us to measure relatively. Hey, within Clarity, we showed a $3 million valuation last time. Now we've gone up, we're using the same methodology. Now we've gone up to a $5 million valuation. That might not be exactly what the company's worth, but it shows the increase in the relative valuation using the same methodology, right? It does help us to understand that the valuation did change, right?
I mean, a funny point about yesterday, the son said, "Dad, I want the lower valuation. So one day when we transfer, I don't owe you as much."
Yeah. Depends if you're helping the buyer or the seller.
Actually, that's really funny though, because all joking aside, I had a situation over the last year which was really, really contentious and really, really difficult. Two brothers were selling in a succession situation to two next generation people, and one of those sellers, one of the elders, got hooked on this valuation number and would not let it go. And that's where I think, again, we got to be careful mentally. They get anchored, and we can talk as much about reality as we want to. When they hear the number they want to hear,
Yeah,
and they're holding the cards, and there's family, there's blood on the line, right? It gets really wacky. We got to be careful.
Yeah.
So Ed, can I ask you a question? You're on. I see you're here. So you're a valuation person. So how would you compare the valuation number we come up with at Clarity, but Clarity too? We do the range of value. We do that whole routine, and we use a multiple, and let's assume that we have adjusted the EBITDA. We do some kind of normalization of EBITDA, and we use the particular multiple for that. And really, even more detailed, if we can drill down and get a specialty multiple for that. How does that compare to a formal valuation of the companies? I just want your perspective on it. I know we've talked about it, but you do this a lot. So I want to know how you see the two and what the strengths and weaknesses are of either one.
Yeah, I think the observations that I see when I encounter those types of discussions and issues, I see people who, when they get a machine-generated calculation, whether it be Growth Drive or any of the other systems that are out there, somehow people believe if it's the number they're looking for, it's got to be right.
Of course.
And then when I go through and look at the calculation and go through and do the actual usage of the detail, I do comparative industry data and analytics. And then I look at the income and the projection of performance of the business with the discounted cash flow. I suddenly bring forth some ideas and points that don't get comprehensively included in the machine-generated calculation, because I'm looking at specific facts and issues pertinent right to this company that don't necessarily get comprehensively incorporated into the machine-generated information. A good example, I just finished one where the people all estimated that the business was going to be worth between $1.75 and $2 million. And I came up with a value of $3 million, and they said to me, "Well, you're so far off, it's ridiculous." When I showed them how I did it, and I was not using market information, I used a capitalization approach, and then said, when I did the calculation, it was worth 1.4 million initially, and then I said, well, then let's do the capitalization, a direct capitalization of normalized earnings, and we looked at that, and then I said, I got a better idea. Why don't we take a look at market multiples and see what that would look like from a point of view? So I ran it against the market. And when I did that, I came up with a value that was like 2.4 million. But then I told them, the $700,000 you have as cash on the books, you only need 200 at best to maintain it. So that's how I arrived at the 3 million calculation. And the person said, well, we ignored the cash because the cash is just being built up. And I said, but it's the incorporation is the whole thing is in a trust. Do you realize you're going to be paying 37% tax on that in the trust? Have you ever considered, is that the way it was really intended? And so bounced it back to the attorney and said, after the valuation is up to the attorney to discuss the impact of that with the family members when they put that into the trust.
So, but Ed, did you issue a formal valuation report?
I did. Yes, I did.
Okay.
Yep. And see, when they were doing all of the machine generated numbers, they were, half of what I was at. But the machine doesn't look at excess cash on the balance sheet because they don't know they have it because they're not looking at that information.
Yep.
And then I looked at the difference between a cash tax return and accrual financial statements. And when I went to accrual financial statements, that's when I suddenly had inventory and receivables that were not on the balance sheet for the that everybody talked about. And so, I mean, that's one of the benefits that we have of going in and looking at the valuation. I look at everything on the balance sheet. I don't just take the P&L and say, "Oh, here's how they're performing."
Yep.
So you're adding back non-operating assets.
Correct. Or excess operating
Or excess working capital.
excess working capital, correct.
Yeah, I got you.
And Ed, I like the statement that you made. You confirmed your cap rate valuation before the excess cash by looking at multiples to make sure that you are coming to the same value as the multiples were.
Well, exactly. I think, Eric, that's one of the things that I really am careful about, making sure that we come up with the right cap rate for a company.
Yeah.
And because when this company has performed so steady over the past 12 years, I mean, I only asked for 5 years, but they gave me a summary of 12 years of performance that they do internally for the owners of the company because it's run by a person that's not family member. And the lady who's the president said to me, he says, "We are so predictable." She says, "I hate to say it, it's like the 24-hour clock. It's going to keep cranking and cranking and cranking." I said, "Well, what are you doing to find new markets for your opportunity? Because the largest competitor against them is a German company. And they don't bother to come into the US after the market that this group has.
Yeah.
And they don't go overseas because they don't want to get into that situation."
Yeah.
And she said, "You asked the question exactly what I'm asking the owners. Can I get out of the range of what I'm doing and expand beyond because we have more technology that we're not allowed to market?"
Yeah. Yep. Wow. And by the way, we haven't even talked about a valuation of intellectual property or other things that, we talked about taking the cash off that isn't in there, right? But we haven't even talked about valuation for assets that aren't in that are additional to the earnings, right?
That's and that often, ironically, in some transactions, I end up having to value the IP, and I'll be a subcontractor to PwC or
Yep.
Deloitte or other firms like that when they know they have something, but they don't want to do that one because they're involved with the super part of the transaction, and they
Yep.
need a subset from somebody who can do something like that. That's going to add and help to make their life easier because they got somebody else that they can rely on.
Yeah. But it changes, just like your cash discussion, it changes the valuation considerably,
Oh,
especially if they have some really, really powerful IP, right? Something.
right. I did one relative to Cabela's. I was valuing the technology and IP on that make socks for Cabela's, and it was the entire company was in an ESOP, and the ESOP needed a valuation, and the value of the intellectual property was in excess of the value of the company. And the trustee of the ESOP said, "That's what we want to know because we need to get the last bit of the ESOP purchased from the original founders who have the rights to the patents on these things. So we need to get that value
Well,
taken from there."
and this goes back to the bigger picture of being advisors, right? One of the things I've advised clients on is take the intellectual property out of the operating company, just like you do with real estate, put it
Right.
in a separate company and license it to the company. Now you've got valuation potential for that separate company because it owns the intellectual rights. And it may be that that you can license it to multiple people and still be okay with your operating company having the license to it. Maybe you do want it to be exclusive, but if it's exclusive, then there should be a premium on that, right?
Correct.
And so there's all kinds of, we think about it for real estate at a higher level, right? thinking about those kind of things, but there's all kinds of pieces to this puzzle that we often we're leaving chips on the table.
You hit it nail on the head there, Eric, in that I did one for a pharmaceutical, and they put the pharmaceutical intellectual property into a separate entity so that it was licensed to the operating company, because the founders that had developed it were not involved with the operations, and they didn't want that to be cross utilized. And so on. I valued the intellectual property before they were in the marketplace at about $2 million. Well, revenue right now is running around $42 million, but I valued the intellectual property at $2 million before it ever got into the market, because I did not have a good foundational ability to determine if you market it only through doctors,
Yep.
can you manage and control it without being in a conflict of interest? And we had a very, very long discussion with the attorneys on the entire effort, and they all said it'll never be a conflict. And I went to non-IP attorneys, and they said, I think they're totally wrong.
Yep.
So I took the conservative approach and went down from 10 million to 2 million.
Yep. Yep. This is interesting stuff. Hey, we're at the 9:25 mark here, essentially. Do we want to George's to honor George's spirit here, even though he's not here with us today? Do we want to go around and talk about takeaways? We've been in a pretty meaty topic here. We want to spend a little time on takeaways here, guys.
Let's do it.
I'll
Yeah.
jump in and say that I got to talk to Ed about how you value IP, because I come across that with some of the work I do, and I don't have a basis for it. And I'll pass to Tip.
Yeah, it's really funny. Just a sidelight with what Ed was saying. My understanding is, at least in the state of Michigan, royalties are taxed differently than regular income. So it is advantageous to be in a separate LLC. My biggest takeaway or key takeaway from this whole thing, thank you, Larry, for bringing up your situation, is I am not going to go into these owner altitude sessions that I have, meeting people for the first time and saying that here's what your company's worth. That's my big takeaway. It's working the gaps, and I'll hand it off to Michael.
Yeah. Yeah. So, yeah. So my big takeaway is understanding that the estimate of value that we show is just that. It's an estimate. It's not a formal valuation. It's just an estimate of value. And it could be close to the true market value, but we're not going to represent that. But the real goal of what we're doing is to, as Tip alluded to, we want to show them where the potential is and where the gaps are and how to close the value gap in their business. And that's the whole purpose of the exercise in the software, is to show them how they can increase their transferable value. And we're using a measurement stick, and it's not perfect, it's not precise, but it is a benchmark, and it's a good start. So that's what I got. So I'll pass it on to John.
Yeah, I would just reiterate what you guys are saying. I'm not a valuation or a numbers guy either. I do think Chip's right. To me, the conversation is always around strategic capacity. It's around growth. It's around transferring the business and, helping them identify, and this is another conversation maybe for next week, which is, I'm completing the C3D certification. And as I'm starting to really learn these growth driving attributes, what comes to mind for me from a planning perspective is how to prioritize, right? Because one of the things I've learned when I left the law practice and became an advisor is my number one goal is to not lose momentum with the client, right? For those that have 2, 3, 4, 5 ongoing engagements, you got to keep momentum. And so how to prioritize which of these value growth objectives to go after and when, to me, that is the secret sauce. So I'd really love to have that conversation with you mind splits, and learn more how you prioritize. I have my own instincts, but they're just instincts. So anyways, that's it. Larry?
Well, I'm going to play off of what you just said first, John. And that is, yesterday with this group, we identified 6 misalignments between father and son owners. But you could overwhelm them. So I don't begin with that. Yesterday was first about strategic intent of where they're taking the business. Where are they aligned with that strategic intent and where they're not aligned? The misalignment was small. It was more about methodology. And then what were we going to preserve in the way of the secret sauce that made them a $140 million company as the sun modernizes? So within that context, the 6 gaps that existed, we only looked at 3 that are interrelated in dimension 1. And we're starting just with dimension 1. Otherwise, we overwhelm our client. And I focused in on that. It was well received. And I said, gentlemen, don't even worry about the other 3 right now. We'll get that later. So let's develop an action plan that preserves what got you here, your secret sauce, your agility, your customer focus, and modernizes certain processes around sales, recurring revenue, and customer satisfaction. That was well received. So if we're good at knowing our client based on our relationship, our credibility, and that box that we should keep ourselves in without overextending, and I think we could do really great work. Even if the other data shows a lot more, our job is to put that aside and say, here's where we're focused. So what I learned today, though, is, and I appreciate it, Eric, is that I'm still in the learning phase when it comes to some of this valuation capability of our system. I already emailed George and copied to Eric about the Monday morning at the summit. And I know, Paul, you can't make it, but for others, that we dive deep into how, when, why we use the tools beyond just Clarity One.
Yeah.
All right, Jemiah.
I mean, a lot of meat. I came in a little late, but it still was a lot of meat that I got. I guess going to your point, Larry, and everybody else, is kind of keeping the main thing, and partnering with everything else. Like, I'm not an accountant, so I can reach out to Eric. I'm not a valuation expert. I can reach out to Ed if I need help with working, with the leadership and the strategic capacity organization. I can reach out to Larry, but focusing on the things I'm great at and using that to, I'm a growth driver. I'm driving the growth, and these are the things that can help drive the growth. These are your strengths, and I can partner for your weaknesses, and not trying to be, as everyone was kind of saying, and what Tip was saying too, not trying to be the valuation expert, not trying to be the numbers expert, but these are the things that we can do to drive growth so that you have options in the 3 dimensions. So great meaty discussion and great points as well. And
So Ed left. Ed.
Pass it to you, Ed.
Yeah, I think the point that I guess everybody needs to be aware of, and that is, just because we generate a value via the calculation, we can't rest on our laurels and believe it's fact. It's a suggestion and it's a guide. I guess it's like some of the publications that go out and say, well, a car dealership sell for something and gas stations sell for something. And it's the same thing when you look at real estate. Real estate of certain in each city has a perspective of value, but it's not the same in every city. And I think that's all I can say is guideline calculations that are developed by our software are really guidelines. And we got to recognize that we cannot represent that is a fact. It's a guide. And I don't want us to get into a position of saying, well, this is the value that we have and that your business is worth that. It's a fault we can't make. We have to be more saying that this is what the calculation right now tells us. And we use that as an idea of what can we work on at the business to improve its value by way of analyzing and delving on operational and other aspects of the business that could improve that calculation.
Yeah. And I'm going to finish with a quick story about a client that I'm in the middle of right now. They 2 brothers-in-law, one owns the majority of the company, like 90-10 split. The 90% owner hired a broker to help them go through the transaction. I recommended that we get an outside valuation so that we could look at fairness so that everybody could see a, and I wanted not just a calculation of value as we were talking about, but an actual certified valuation so that it went through the rigor of the process that Ed was talking about and that we were talking about earlier. We got down that process, and then the broker started jumping in and manipulating the value, the forecast, so that we could get up closer to the value that he wanted. And so I went to the buyer, the brother-in-law, and said, look, let's just go back and offer them the money that they wanted at the start. They wanted to just go to an LOI at a number they had in mind, because this is going to be a game of us just arguing over what's the basis of the forecast. And so in the end, we cut the valuation out. We went back to the number that was 10% higher than we wanted to pay, but he was going to manipulate, he was going to argue all day long to get to a higher value. And so you got to understand when to play what card in the process, right? And so it was just back to Tip's point, this is our process is about one thing, but back to Tip's broader point, you got to know when you want to stick with the valuation and when you want to just go with your gut on what's worth and cut to the chase. We wanted to get the deal done, and we knew that was going to drag out with this argument. And so we ended up saying, let's not do the valuation. Let's just agree to their 10% higher valuation. And so you just got to understand where you are. We had a good idea where we should be because we had done a calculation of value, not, we had used clarity, but we had actually enhanced it with looking up the value, the range of value for their particular thing. We had looked at average weighted EBITDA. We had done all that, which is why we came to a different value number than they did. They just took last year, which was an out year performance, and multiplied it times the highest range in the value and came up with their value. And that's why we didn't want to pay it. So you got to know when you're going to use, this is the judgment factor, guys, and you got to know when to use the tool. Hey, great meeting, guys. Really, really healthy discussion.
Thanks, everybody.
Yeah. Thanks for leading, Eric.
Have a great day.